Hello everybody, here we are again. So earlier this week, I was on holiday with my lovely daughter Lily. She's a newly qualified doctor. She's just bought her first house. She's renting out a couple of rooms to help make ends meet. And she said to me, Mum, is the budget going to affect me? So like any good tax advisor, first thing I did was give her a fee quote, got her to sign an engagement letter. And then I said to her, well, Lily, I said, the government have said they're not going to increase income tax or national insurance. So your pay packet from the NHS should be the same. You've got your little savings in an ISA, so you should be absolutely fine. Totally wrong. As Graham said earlier, she's now on the hook for an extra 2% tax on her rental income. And let's just say she was hugely unimpressed with her mother's tax advice. I had to waive the fee and everything. So turning to other property tax predictions that I also got wrong, let's have a look at the mansion tax, officially known as the high value council tax surcharge. The Institute for Fiscal Studies stated earlier this month that property tax is in desperate need of reform. And I find it hard to disagree with that when council tax bands have not been recalibrated since 1991, and I'm paying more council tax than a Russian oligarch. The mansion tax will see an annual £2,500 charge for properties in England worth over 2 million, rising to £7,500 for properties worth over 5 million. The estate agents Savills have said there are around 145,000 properties worth over 2 million. So that's less than 1% of properties that are going to be hit by this new tax. But I think it's fair to say that the vast majority of those are in London and the South East. For people who are buying new homes, it's unlikely to cause an issue, perhaps. If somebody can afford to pay over £500,000 in stamp duty land tax on their £5 million house, maybe £7,000 a year is doable. But for people who bought or inherited their homes many, many years ago and now maybe live off their pensions, things are going to look a bit different. And I imagine that there will be some people who simply can't afford an extra £300, £400, £500 or even £600 a month more to pay this tax. Might we see some of these larger houses coming onto the market over the next couple of years? Yeah, quite possibly. The other property-related issue that I wanted to mention was an announcement that was made just before the budget, actually, that English regional mayors will be given the power to charge tourists a tax for staying in their towns and cities overnight. So next year, Essex is set to have its first elected mayor, very exciting. And Norfolk and Suffolk will also be electing a joint mayor in May 26. Will one of their first acts be to introduce a tourist tax? We'll have to wait and see, but I predict yes. Both Scotland and Wales are bringing in a tourist tax next year. £1.30 a night in Wales and 5% in Scotland, which is quite a lot. Hospitality representatives have warned, of course, that it's not just a tourist tax. It's going to apply to anyone. So UK holiday makers on weekend breaks to Aldborough, people visiting friends and family in Essex, or workers staying in the Holiday Inn Orwell, like I did last night, would also have to pay the tax. And opponents of the plans are saying that the costs are just going to be passed to the consumer and it's going to drive inflation. On the flip side, tourist taxes in other countries seem to have had minimal impact on the number of visitors, and it would potentially be a valuable source of funding for investment in our region's infrastructure. Maybe they could finally get rid of the potholes. However, for those of you in this room and watching online who own holiday lets, B&Bs or guest houses, if a tourist tax is introduced, it's going to be yet another compliance burden to navigate, hot on the heels of making tax digital for landlords. The plans are subject to a consultation, which is running until February, and we'll be issuing updates on this via our website and also in our property and construction newsletters as soon as we know more. So do keep a lookout for those. I mentioned earlier that I was on holiday with my daughter at the beginning of the week. We actually met in France, which is where my son lives. And so as one of my children is currently non-resident, I was keen to see what changes were announced that might affect him and, of course, anyone else who is currently located overseas but who is paying tax in the UK. So the main changes for non-residents are as follows. These are quite technical, so just bear with me for the next minute or so. Firstly, the abolition of a tax credit for non-residents. The dividend tax credit for UK residents was abolished ages ago, actually. So this measure just means that from April 2026, the tax paid by non-residents with UK dividend income will be the same as the tax that's paid by people who are living in the UK. There was another tweak to the rules related to dividend income, which will apply to individuals who are temporarily non-resident. Temporary non-resident broadly means somebody who leaves the UK and then comes back within 5 years. So currently, if someone leaves the UK, their company makes money while they're abroad, and they pay themselves a dividend from those post-departure profits. That dividend income is exempt from UK tax, even if they come back the next day. But from 2026, all UK dividends received from a close company while a shareholder is overseas will be chargeable to tax if they are outside of the UK for less than that 5-year period. I also want to mention an IHT change for non-residents. So currently, inheritance tax anti-avoidance provisions look through offshore structures where they're holding UK residential property. So what that means is if someone's living in Dubai and they've got a UK house owned through a Jersey trust, for example, they're still going to pay IHT on that property when they die. The government announced yesterday that it's going to extend this treatment to UK agricultural property as well. So if anyone here has farmland or farm buildings that are owned through an offshore company or a trust structure, please reach out to your Scrutton Bland contact to discuss the implications of this change and find out what options might be available to you. Finally, I was asked to summarise the VAT changes. And in no particular order, VAT relief is going to be available to businesses who donate goods to charities. Mandatory e-invoicing is being introduced for VAT invoices from 2029. Penalties for late payment of VAT are going up from April 27. We're getting another consultation on reforming VAT to incentivise development of land for social housing. Certain private hire suppliers are to be excluded from the tour operators margin scheme from the new year. That basically means that Uber will have to start paying VAT after Christmas. And finally, effective immediately, HMRC now considers that if a business which is VAT grouped in the UK has an overseas establishment, that overseas establishment should be included in the VAT group. I am reliably informed by our resident VAT specialist that VAT groups who have previously accounted for VAT under the reverse charge mechanism may now be eligible to claim a refund via an error correction notice. So if you think any of these VAT changes might affect you, please don't contact me, but please do contact our VAT team. We are awaiting further details on lots of these measures over the coming weeks and months, so also keep an eye on our VAT newsletter for updates. And that's me done until next year. Thank you, everybody. Back to Jason.